Speaking of stocks, the best way to invest in stocks. Now, I spent a lot of time looking at this over the last couple of decades, and I am firmly convinced that the best way to invest in stocks is to simply buy them all. Truly, it is the best way. And there's a lot of reasons why. One of the reasons is that it gives you better performance. Okay. So, what am I talking about when I'm talking about buying them all? I'm talking about using a low cost, broadly diversified index mutual fund, such as those you buy from Vanguard, Fidelity, Schwab, iShares, State Street on the ETF side. These are mutual funds that just buy all the stocks, such as the Vanguard Total Stock Market Index Fund. Right? This buys all the stocks in the US. The Vanguard International Stock Index Fund, Total International Stock Index Fund. It buys all the stocks outside the US. Between the two of those, you own all the publicly traded companies in the world. It's not entirely correct. They actually do some sampling, but your performance is the same as though you bought all of the companies in the world that are publicly traded. You can even do that with one fund. It's called VT on the ETF side, but it's basically an all-world index fund. I don't know that I necessarily recommend that. It actually costs more than just buying the two separate parts. But and you also lose your foreign tax credit, which is unfortunate. But that's getting into the weeds. The point is, when you buy these index funds, you get better performance. The vast majority of the time, for the vast majority of people, compared to the alternatives. And what are the alternatives? Well, one alternative is hiring somebody else to pick all the good stocks. That's called an actively managed fund manager or a separately managed accounts manager. You're hiring a professional to try to beat the market. And the truth is that most of these professionals do not beat the market. They don't beat the market before tax, and they certainly don't do it after tax. The data is pretty clear that an index fund over time, and I'm talking about an investing career, 20, 25, 30 years, over time is going to beat somewhere between 80% and 98% of the active managers. Is it still possible to beat the index fund? Absolutely, it's possible. But is that a bet you should make? Not really. That's not a bet you should make, number one. Number two, the downside of doing that, aside from the risk, is a whole lot of time and effort and education and trouble and hassle. And that's probably not worth it either. Okay, so the other thing you can do besides hire a professional and try to beat the market is try to beat the market yourself. If all these professionals are struggling to do it with the world's fastest computers and with all these specialists and super educated people they're sending out to talk to all these people at all these companies all over the world, if they're struggling to do it, why do you think you're going to be able to do it in between patients? The odds are just not with you. And if it turns out you are really good at it, you shouldn't just be managing your own portfolio. You ought to be managing money for other people and charging them 2 and 10 to do it because they will gladly pay you if you can reliably beat the market over the long term. So what do you get with an index fund? Number one, you get better performance. And that is why 85% of my portfolio is invested in index funds, publicly traded securities, stocks, bonds, real estate. 85% of my portfolio. It's been that way for a long, long time. We've been getting some feedback lately. Hey, it's like everything's real estate these days. Well, yeah, we have a bunch of new real estate advertisers here at the White Coat Investor. My portfolio hasn't changed, and neither has my recommendation of how to invest. I think most people ought to have stocks in their portfolio. And the way to invest in stocks is using index funds. All right. Another great benefit of index funds is just less time consuming. You don't have to watch the managers. You don't have to track performance and worry about them losing their touch. You don't have to diversify between managers. You don't need a manager. It's just a computer managing them. You're buying all the stocks. One fund is fine. I have 25% of my portfolio in the total stock market index fund. It's actually in the ETF version in my taxable account, but same thing, really. That's it. It's a whole lot of money in one mutual fund. Very non-time consuming, very boring, very effective over the long run. Okay, another reason to use index funds are less risky. Not only do you not have manager risk, you got more diversification, and there's just less risk there compared to the alternatives. It's better. It's Better performance, less risk. Okay, another reason is lower cost, and that just leads to better performance. In fact, the main reason why index funds beat actively managed funds most of the time is their costs are much lower. Most actively managed funds are really expensive. If you ever want to try to pick an actively managed fund and give it the best shot you can at beating an index fund, it's important that you choose a low cost one. That helps minimize the advantages of indexing. Index funds are also more tax efficient. Most of my stocks are now in my taxable accounts. So tax efficiency matters a lot to me. I'm in the highest bracket, both for capital gains and for regular income. And so tax efficiency is a big piece of it. And index funds are more tax efficient. They have almost no turnover, at least the broadly diversified ones. So you're paying almost nothing in capital gains year to year as the investments grow. I can't remember the last time the Vanguard Total Stock Market Index Fund distributed a capital gain. It just doesn't do it. You get dividends. Yeah, they have to send you the dividends, but at least you get to pay it the long-term or the qualified dividend rate on those. Okay, another good reason for index funds, they're very easy portfolio building blocks, right? You decide, well, my asset allocation is going to be 15% international stocks. Okay, well, you can get that with one simple index fund, a total international stock market index fund. It's just really easy to build a portfolio. It's really easy to go from your asset allocation to your actual investments when you're using index funds. Another great thing about index funds, they're widely available. Almost every 401k and 403b and 457b has got index funds available in it now. You can get them whether you're at Schwab or Fidelity or Vanguard. If you're another brokerage, you ought to really be asking yourself why. But even if you are, you can buy an ETF from Vanguard or iShares or State Street at that brokerage. They're just widely available. They're all over the place. You're always guaranteed to capture the market return. And, another nice thing about at least total market funds is there's no factor risks, right? You've heard of factors. These are people that tilt their portfolio to small and value, and you can get a small value index fund too. But when we're talking about total market funds, there's no factor risks. For example, these small value stocks are supposed to outperform in the long term, right? Well, that hasn't been the case for the last 10 to 15-ish years. They've underperformed the overall market. You don't have to worry about that when you're investing in a total market index fund. So another advantage of these broadly diversified funds. And perhaps the best reason to use them is it just minimizes regret. Okay? You don't have to worry about, I picked that crappy fund, or I shouldn't have been picking my own stocks, or how about this one, right? There's somebody at a cocktail party bragging that they own Tesla or whatever the hot stock of the day is. Well, you own that. You owned it before it went big because you own all the stocks. So you always get a minimized regret. And you can brag that you own that stock even before this person at the cocktail party did. All right. Index funds. They're good investments. If you're investing in the stock market, it is the way to invest. And, and if you're not investing in the stock market, you really ought to consider it for part, at least, of your portfolio.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.